have done with the percent of sales method is we have created a target. Like we have said that we want our future projected numbers to be a constant percentage of sales. Sometimes when we are forecasting, instead of using a percent of sales method, we may target specific ratios and say that in the future the company wants to maintain a current ratio of whatever 1.5. Then how should our numbers adjust based on our projected increase in sales so that we can maintain that target? That becomes particularly relevant in the context of debt covenants, because debt covenants may require companies to maintain targeted ratios. So when we think about the decision how much to finance a company or how to finance a company, we have to recognize that the investments that we have to make based on our increased sales, what we pay out as dividends or retain in the form of retained earnings, and thus how much we finance are all linked together. And a good financial manager must balance these decisions. They have to figure out, based on either debt covenants or other considerations, how can they create a balance between new investments, what they pay out as dividends, and how much they finance for those new expansions. So forecasting has consequences, and thus it has to be undertaken very carefully. One of the challenges with the percent of sales method is that it ignores what we call lumpy investments in capacity. If there are, instead of a smooth investment, which is a certain percentage of sales, so as sales increase, your investments increase, sometimes the real world does not work that way. In a given year, you may have very large investments because the plant or the new equipment that you are buying at that year just has a large cash outlay. And thus, in a certain year, your investments may be lumpy. So instead of having that smooth curve, you are going to have lumpy investments during the future period. Because, of course, you can't buy half a factory or simply add retail space based on a smooth projection of your sales. If you're planning to increase, let's say you are a department store and you are forecasting that your sales would increase by 10%, it's not that you can immediately add 10% of floor space to your store. Maybe if you take the next door floor space to add to your department store, you have to take the entire floor space, which may be 20%, 30% of what you above what you need. That's what we mean by lumpy investments in capacity. So firms often make large investments in a certain year, and then they expect that that investment will pay off over many different years. So when we want to analyze the effect of such planned expansion, we have to identify capacity, and we have to look at what our financing needs are. We have to construct our pro forma income statements based on our projection of future cash flows. And then we have to use the forecasted future cash flows to assess the impact of such an expansion. So three-step process: identify need, then construct pro forma income statement based on this forecast of future cash flows, then calculate future free cash flows to assess what is the net impact of that expansion. So here is an example that the book has outlined for us. We'll just use this as an exposition. So in table 18.5, that's what we have over here, we see that KMS expects both total market size and its share of the market to grow to the point where the company will quickly exceed capacity. Thus, KMS is considering an expansion that will increase its capacity to 2 million units, enough to handle its projected requirements through 2018. So what is KMS doing now? Instead of simply projecting sales, they're looking at what the overall market size is going to be for their market. Then they're looking at what kind of market share they will have, and they're projecting that they will over time increase their market share. So thus, production volume will have to increase based on increases in overall market size and increases in production volume. So they multiply increases in market share, so they get their new production volume. In addition, what they're looking at is their projected sales price over that period. So they're increasing production volume as well as they're increasing sales price. So to estimate KMS's financing needs based on this increase in both market size, market share, and sales price, we have to look at the capital expenditure that KMS would be undertaking. So KMS thinks that to meet these increased demands all the way up to 2018, they have to make an investment now. And they have to make an investment of $20 million today in plant, property, and equipment. And then KMS must invest $5 million each year to replace the depreciated equipment as the equipment gets wear and tear, and that requires maintenance, that they will have to invest additional $5 million so that they can make that investment. And so after the expansion, KMS must invest $8 million per year for depreciation between 2015 and 2018. So those are the assumptions that they have made. So now we are looking at so table 18.6 is looking at the depreciation schedule for a particular type of property. This type of property that they are trying to invest in. So they have $5 million of ongoing maintenance, but in 2014 they're making this lumpy investment of $20 million. So their net investment in 2014 would be the $20 million plus the $5 million that they have in ongoing investment, capital investment. And then in the subsequent years, capital investment would be $8 million. So now, based on new investments and the book value, this is the book value that they have for their fixed assets. So in 2013, book value was $49,919, and you can find that that information on the book value is provided is assumed to be there. It's 49.919, and then the subsequent book values are based on the projection on a percentage of sales method. So now we take the opening book value, subtract the depreciation for that particular year, and then we get our closing book values. Okay. Now to finance this recurring investment from operating cash flow, they will have to finance this expansion. And what are the sources? They will finance it, number one, through operating cash. And also they will finance this new equipment by issuing a 10-year coupon bond with a coupon rate of 6.8%. So interest in year T will be the interest rate multiplied by the ending balance in that particular year, in the previous year. So this is interest rate in year T multiplied by the balance in year T minus 1. Okay, the previous year. So based on that, you can project out the outstanding debt, how much debt they will have. Of course, this is the lumpy thing that they're doing, and this is the additional amount that they're borrowing, and that will then project out the interest rate that they will pay. Based on this additional borrowing, these are the additional interest rates that they're paying. And then from this, we can project out, once we have all of that done, then we can project out the pro forma income statement. We can look at sales as a product of the market size, the market share, and average sales price. So we had looked at those numbers in table 18.5. So we use those numbers to project out the sales. Then we can project out costs except depreciation, which is a percentage of sales. That will give us EBITDA. Depreciation we have already calculated in the previous slide, previous table. That gives us EBIT. Then we take interest expenses. That gives us pre-tax income. Then we pay our income taxes and we get our net income. So pretty straightforward. So we have to also take into account that working capital may increase as a result of any additional inventory, accounts receivable, or accounts payable adjustments that we will have to make. We have to realize that 16% of sales was accounts receivable. Cash requirement will be 16% of sales. Accounts receivable will be 19% of sales. Inventory would be 20% of sales, and accounts payable would be 16% of sales. These are based on the percentage of sales number we had in 2013, and then any extra cash, we will distribute those as dividends. So based on that, we project out our cash, accounts receivable as a percentage of sales, because we have projected our sales. Then as a percentage of sales, we project these numbers. Similarly, accounts payable, and then we can calculate net working capital. Net working capital is the difference between current assets and current liabilities, line number 7 and line number 10. That's net working capital. And the difference between the net working capital is the increases in net working capital. So from 2013 to 2014, net working capital increased by 5257. From 2014 to 2015, it increased by 5802. Then it increased by 6453, and so on and so forth. Those are the increases in net working capital. So now we can forecast the balance sheet, and if we forecast the balance sheet and we find that the liability plus equity is greater than our assets, then we will have excess cash available to us, which we can either use to build cash reserves, pay off debt, pay out extra dividends, or buy back shares. But if liability plus equity, the right-hand side of the balance sheet, projected pro forma right-hand side, is less than assets, then that will tell us that we need additional financing. So that's what we are doing in 2014. Based on these numbers, we have projected out our total assets and our total liability plus equity. And what do we find? We find that the total liability plus equity exceeds our total assets. So that means we have extra cash, which means we can pay out extra cash as dividends if that's what we decide to do, and we pay out essentially the difference between 120,373 minus 115,587. We pay that out as dividends, and once we pay that out, then assets once again gets back into balance between liability and equity. So essentially, by paying out that extra cash, the difference between these two of 4,786, we have paid out that extra cash as dividends, so we have reduced our shareholder equity by that much, so this number goes back into line with total assets. So if liabilities and equities are less than asset, then new financing would be needed. If liability and equity is greater than asset, then extra cash would be available. And in our example over here, we chose to pay out the extra cash in the form of dividends. But there are other options available to us if we choose to use them that way. So the last thing we will do in chapter 18 is section 18.4. where we find out where does growth come from, and how do we then anticipate how to project future growth. And there are two types of growth we have, something that we call the internal growth rate. The internal growth rate is essentially the internal growth rate is its return on asset. It is essentially telling us how fast assets can grow if you only use net income to invest in the asset. So, and we calculate internal growth rate by multiplying the return on asset, which is net income divided by assets. We multiply that by the retention rate. The retention rate is essentially 1 minus the dividend payout rate. 1 minus the dividend payout rate. So if you're paying out 30% of your income as dividend, then retention rate is 70%, and so on and so forth. In addition, we can calculate something called a sustainable growth rate. Sustainable growth rate tells us how fast the firm can grow by reinvesting its retained earnings and issuing only as much new debt as can be supported by those retained earnings. So two things, it is reinvesting retained earnings, which is like internal growth rate, but it is also taking into account the possibility of additional new debt that can be used. So we take ROE and multiply that by retention rate. And ROE is again net income, but this time we are dividing that by equity. So we are taking into account any possibility of new debt. So here is an example. A firm has 70 million in equity and 30 million in debt, and it is forecasting 14 million in net income. It currently pays dividends, that is 20% of its net income. They are analyzing a potential change in payout policy, an increase in dividends to 30%. How would this change affect your internal and sustainable growth rates? So to compute internal and sustainable growth rates, you will need ROA, ROE, and retention rate, or what is also called the plowback rate. The company has 100 million in total asset, which is 70 million in equity plus 30 million in debt. So 100 million is total assets. So net income would be, ROA would be net income divided by assets, that's 14%, and ROE would be net income divided by equity, which is 20%. Retention rate, the original retention rate was going to be 80% because we are paying out 20% in equity, but the new retention rate is going to be 70% because we are increasing the amount of dividend that we are paying out. For whatever reason, we made that decision. So then the old internal growth rate would be ROA multiplied by the old retention rate, ROA times the old retention rate, and the new growth rate would be the same ROA multiplied by the new retention rate. So as we are paying out more in dividends, what is the trade-off we are making? We are reducing the overall rate of growth in the firm. Same thing over here. Initial sustainable growth rate was 16%, but now the new sustainable growth rate, because of lower retention rate or higher dividend payout, our sustainable growth rate has gone down to 14%. So similarly, you can work out these other problems that are similar but with different numbers. So growth can be financed by reinvesting retained earnings or reinvesting retained earnings and adding on new debt, but in a manner that keeps the debt to equity ratio constant. So those are the two ways in which growth can be financed in a firm. But if a firm wants to grow faster, a firm must either reduce payout or raise external capital, reduce payout, raise new equity, or increase leverage if they want to increase growth. And thus growth has an impact on value. When the firm is growing faster, then you can see that when growth rates are faster, stock prices will be impacted by the rates of growth. And the way we find the impact of growth on stock price is to calculate our free cash flow for the firm and use those free cash flow to find out the present value of those free cash flows. So once we have this free cash flow number, then we calculate present value of free cash flow. The last part is in section 18.5. I've just briefly alluded to this over here, but I don't want you to spend too much time on section 18.5. It's just there mostly for informational purposes as to how growth rates impact firm value, just as reading purposes, not so much for consideration of exam. So for the purposes of exam purpose, you need to stop at section 18.4, which is page 571.